Hello, welcome everybody. We're going to give it a few minutes, probably about 4 or 5 minutes before we kick off. But we'll have hopefully some material for people to look at because there's going to be quite a lot of charts referenced through this piece, the ISM QE Conundrum. So we'll just give it a few minutes to see if anyone else joins in. Hello there. And we'll hopefully get a few more joiners, and then I'll go into it. Hopefully it'll take about 20 minutes, something like that. So hopefully it'll be useful, entertaining. Hi all, good to see you, hear you as well. So hopefully at the bottom, one of my colleagues is going to add, I think it's going to be a Word document. It's got about 30 charts in it, which I will try and keep the order going. But there'll be a good reference point, because otherwise a lot of what I'm going to say is going to reference charts. So it'll be nice to have those on board. So we'll give it two or three minutes. Yeah, when do we hit bottom? Who knows? Not for a while. But this is going to be the big question that hopefully we're going to answer. We'll get some ideas around, which is, do we go up or do we go down? It's pretty binary. But there's some very interesting and conflicting areas around that. So we'll come back to it shortly. Yes, I think it is. I just saw someone say, will this be reposted? I think so. I think we will put it back onto our channel, keep it on the YouTube channel, so it'll be available for others to see as well, I think, but we'll see. So a couple more minutes. It always feels a bit longer than in reality. I think we'll try and wait till about 4 minutes past, 5 minutes past, and then we'll crack on from there. Will be Q&A at the end, and I will try and answer as many of the questions as I can sensibly. So we'll hopefully some of it will get answered as we go along. Who knows? And then we'll try and see where we go from there. Hopefully there'll be some pretty self-explanatory stuff as we go along. But anything that needs clearing up, or anything that's even not connected with what we're going to talk about, broad market-wise, I can give it my best shot and see what we can come up with. Yeah, I think index fund bubble, passive fund bubble, rules-based investing fund bubble, yes. It's there, it's real. It's a framework, and I'm not sure how the framework gets broken, but it's definitely out there. Okay, we're going to start very, very shortly. Has the attachment been added for people to see, to follow from the Word doc? Just checking. Hold on. Bear with me a second. There we go. Charts are on. Okay, so we've got some charts. I'm going to kick off in a couple of seconds now. And we'll then have questions and answers at the end of it, and hopefully it won't be more than about 20 minutes. Okay, guys, welcome to everybody. Thank you for joining this webinar, the ISM QE Conundrum, in which I'm going to be talking about some things which are really at the very crux of this whole discussion of, is there a recession coming? If there's a recession coming, can central banks do anything about it? And if we do get a recession, will risk assets perform in the way that we've historically expected them to perform? I think it's quite interesting that over the last week or two, we've seen some data which, it's the ISM data, which is continuing this series of very, very weak manufacturing global data, which if you look at that data, I think you'll kind of, the relationship would suggest that based on history, that data suggests that we should be selling equities with extreme prejudice. It's fairly clear that that's what we should be doing. Now, it doesn't necessarily mean we'll get a recession, but it certainly looks like equities could be 20% downside. Really looking at the S&P. And the first chart in my pack is it's a subcomponent of the ISM, which I'll come back to. It's the exports order. But at the same time, if we're seeing a declining manufacturing outlook and a slowdown coming, central banks tell us that they're going to come back, and in fact, some of them already have come back with the expectation of more accommodation, whether it's QE or not, we'll also talk about. The second chart, which I will refer to quite a few times, the second chart is the combined balance sheet of the Bank of Japan, the ECB, the Fed, the PBOC China, and I've got the Bank of England in there, although they don't really count. But it's also very clear that if you think QE is coming back based on the last 10 years, you would be buying equities with extreme prejudice. So we've got this really unusual scenario where the ISM and the manufacturing data is saying sell. Central bank actions, on the other hand, is saying buy. Which one is right, which one is wrong? I'm going to go through what I think are the key elements here, and hopefully we'll get some ideas of which way I think it's going to go and why that's going to be. So first, let's look at the data. The key thing here is the manufacturing data. We're going to talk about services data as well, but manufacturing data. So my third chart is just the headline ISM. Last week, it fell to 47.8. That's the lowest level that we've seen since 2009. It fell marginally below 2016, 2015-16. That was a profits recession in the US. We did see equity market volatility and a significant drawdown, but we didn't quite make it into a full-blown recession. It was a profits recession only. Nonetheless, the headline manufacturing ISM is at its lowest level since 2009. It's in contraction territory, but not recession territory. Generally, sort of rule of thumb is below 50, contraction, below 45, recession. But as we saw in that first chart, certain elements within this are significantly worse, and the export orders is often seen as a lead indicator, and that has collapsed to a level way below the 2016 levels. And this is also seen within this by the subcomponents. Now, there's 18 sectors that the ISM, and the ISM is the Institute of Supply Management. In most countries, this would be the Purchasing Managers Index. It's the ISM in the US. It has 18 industries. 15 of those industries were in contraction in the last survey. So 15 out of 18. If you take the net number, so take your 15 contracting minus your 3 who are expanding, net number of 12 in contraction, that is significantly worse again than anything we saw in 2016, anything we saw in 2011-12 when you had the European crisis. And really, again, you've got to go back to 2009. So once again, the subcomponents of the ISM today, the ISM manufacturing, are significantly worse than in 2016, 15-16, when we had a genuine profits recession and significant drawdowns on the S&P. And we've also got some other corroborating data out there. One of the interesting ones is the Conference Board CEO business confidence, really looking 6 months forward. The level of business confidence amongst CEOs has fallen to a level which has only ever been seen during recessions for the last 40 years. Now, you don't need necessarily have a recession and get confidence this low, but when confidence has been this low, you've had a recession. And I think it's Pigtail may have done this. It's also on the chart, but it was the rate of change, the year-on-year change in this data is actually the worst we've seen since the 1970s. In the 1970s, I mean, that was a pretty awful time. You had obviously bouts of massive inflation, a lot of regulation. So this year-on-year change in this data point is the worst that we've seen. So it kind of corroborates that this is quite a bad downturn in manufacturing. And we're going to come on to manufacturing versus services. But on the face of it, it's undeniable that the manufacturing outlook has taken a significant turn for the worse in the US. Now, that's the US. What about the rest of the world, and particularly Europe? It has been a manufacturing slowdown everywhere, and I think it's fair to say that we are probably in an industrial recession globally already. In Europe, some of the data points are pretty dire. So at the moment, the US is playing catch up to the rest of the world. Europe has been stagnating for a while, but this has all been focused on Germany. And I think in some ways, this is another key element, is that people say, well, Europe, it's Germany. Germany's getting its payback for being the robust economy, particularly during the European crisis back in 2011 and 12. But German PMI, and this is it's a fairly narrow in terms of the variety of industry it has, but it's an industrial economy, it's an exporting economy. Its PMI has been below 50, so in contraction territory for pretty much the whole of this year. And it's been in recession territory, sub 45, for the last 6 months. It's recently hit 41.3. Germany's manufacturing PMI is absolutely dire. But it's not the only one. It was on its own really before, but now we're also seeing other parts of Europe and areas connected to Europe. So Russia's PMI, that's also tumbling. That's now fallen into the 46 region. So this has been holding up near 50, but has taken a big turn for the worse in the last month. Then perhaps the most shocking one was Sweden. Now, Sweden, like Korea, obviously in Asia, has its own currency, is an exporter, very open economy, focused on exporting. And this one had held up. This one had been above 50 for, well, pretty much the whole time. So it didn't look very, very robust. Then all of a sudden, last month, people were expecting 52. We got 46.3. So a significant miss, a significant decline. Why does Sweden matter? Well, Sweden matters because it's an open economy that's often seen as a lead economy to Europe. And we saw this, I think it was Andres Stenos from Nordea, put out the chart, which is my next chart. And this shows that Swedish PMI leading by 2 months versus the European composite PMI suggests that the European composite PMI is now going to fall well below 50. This is no longer just Germany. This is the whole of Europe. And it's Europe which is now feeling the effects of this global manufacturing slowdown that's emanated out of Asia. So manufacturing data in many ways is very, very clearly telling us what a lot of us already know, what a lot of us have always looked at, which is there's this slowdown coming and therefore we need to be cautious. And for Europe, it's got some massive implications because the banking sector in Europe is on its knees. The banking sector in Europe is close to the all-time lows. It's sitting on the 25-year support. In the early part of this decade, when it was the Euro crisis, the European crisis, it was all about the debts at the banks, it was all about the peripheral regions, solvency, liquidity, you name it. Those were the issues. And Germany was relatively immune because it was a strong balance sheet. Well, today this is about an economic slowdown that will now feed into the balance sheets and the liquidity solvency issues of the banks. And here we are sitting on those levels. So it is absolutely mission critical for Europe here, if we are about to go into a true manufacturing global recession, that there is a very, very bad outlook for the banks. So Europe, as always, very, very critical in this overall manufacturing slowdown. So the picture is pretty grim when you look at manufacturing. But then what people always say is, but, hold on a second, that's manufacturing. Manufacturing is a small part of the US economy. It's still a relatively small part of the European economy relative to services. It's services that matter. So let's have a look at that. And I think this is absolutely key. Manufacturing clearly declining, contracting. Has it contracted sufficiently to bring economies into recession? And will the services and the consumer keep the overall picture alive and kicking and prevent a manufacturing and profits recession turning into a true full-blown recession? It's true to say that the last two recessions only became recessions when you saw the services sector falling below 50. So you had already had manufacturing had fallen, manufacturing ISM, and then the services non-manufacturing ISM eventually fell below 50. And on those two occasions, so 2000, 2003, 2007, 8, 9, you got a recession. But on many occasions, we have seen manufacturing fall below 50 without the services or the non-manufacturing fall below 50. Is this another of those occasions? That's one of the big questions people are asking. Well, first, let's look at the non-manufacturing ISM in the US. It has fallen to 52.8, below expectations, but it is still in expansion territory. So at this stage, we'd say, okay, the non-manufacturing sector has slowed, but it's still okay. That much is true. I guess the important element here that we've got to look at is it being led by manufacturing? And if you look at the manufacturing versus the non-manufacturing over the last 25, 30 years, it does look like generally manufacturing leads. We saw that in 2000. We saw it in 2016. And although non-manufacturing didn't fall below 50, it rolled over from a very high level after manufacturing. In 2009, it was coincident because obviously it was driven by credit both at the household domestic services level and at the corporate level. So the whole thing just was correlation to one. Today, we have a pattern which is very similar to 2000 and 1, 2, 3, 2016. But as I've said earlier, the underlying components of manufacturing look a lot worse. So therefore, potentially could pull down the sector, the non-manufacturing sector more. Now, what is also important here is people always say manufacturing, it's 10, 12, maybe 15% of the US GDP. That's true. But it's actually been a small part of US GDP for a long time. It's, you know, even in the heyday of manufacturing in the 60s and 70s, it was about 30, 35%. Even in a manufacturing economy like China, it's 45, 50%, give or take. The point here, though, and this is something which is key. Manufacturing, the manufacturing element of GDP is extremely volatile. So it has a high beta relative to the consumption side. So what that means is that effectively the manufacturing GDP is moving quite rapidly or can move quite rapidly, whereas the consumption services side, it's bigger, but it moves much more gently. You know, you still buy your food, you still drive your car. And Joe Lavorgny, who is the economist when I was at Deutsche Bank, this is back in 15, 16 again. If anyone's on Zero Hedge, you may know him as the weatherman. He got a little bit vilified on Zero Hedge, but he's actually a very good economist, did some great research. And he pointed out that take autos, part of the manufacturing sector. It's been 3% of GDP since the 1960s. I think it's around about 2.9 today. But when you have a proper slowdown, the manufacturing element or the autos element, which is 3% of GDP, in any one quarter could actually lose 2.5%. The point here is that that 3% could be removed from GDP in one fell swoop for a couple of quarters. So there's very, very high sensitivity from manufacturing. So manufacturing is small, but it's very, very key to that sort of GDP numbers. Now, still, the consumer is the one that will take us over the edge, but there's that kind of amplification effect from manufacturing through to the consumer. How many single job in autos are actually supported around that? That's one of those big arguments. So we have to be aware that if manufacturing is properly cratering, it can pull down the less volatile but bigger consumption part of the equation. And that's what we're really watching for here is this move big enough in manufacturing to the downside and broad enough in manufacturing to the downside to have a longer lasting and deeper impact on the services and non-manufacturing part of the market. And remember, in 2015, it took an almighty effort from global policymakers. In 2015, we had that profits recession, but then the Fed relented. They were going to raise rates, and they said, actually, no, we're not going to. You had the Shanghai Accord, where it looks like everybody said, let's try and keep the lid on the dollar, because the dollar had been moving aggressively, which is why we had the profits recession. And you had an almighty injection of credit by the Chinese, which was credit that was there, which was growth at any costs, whereas today Chinese credit is targeting banks and SOEs. Back then it was fixed asset investment, like it was in 2009. 2016, at the beginning, you suddenly saw commodities start to rally. So the almighty effort by central banks helped prevent a profits recession turning into anything deeper or more malignant. So where are we now? Well, even though we have only seen the non-manufacturing part of ISM go down to 52.8, still in expansion territory. When you combine the two, and this is actually a chart by Pictet, you combine the two, the change in both the combined manufacturing and non-manufacturing ISM that we've had would suggest that US equities are due a significant pullback. And this is the key element here, is we might care about a recession, but actually more important than that is, do we get a pullback in risk assets, even without a recession? And the data suggests that the move we've had in both the combined manufacturing and non-manufacturing would lead to a pullback and a drawdown on the S&P. Now I'm going to throw a couple more things in here, the caveats. We'll come on to trade, etc. in a minute. But the first caveat, and it's the chart I've got here. It's a yellow chart, green. I've got a little circle on it. This is the ISM, the headline ISM, versus the year-on-year change of the S&P. And what was noticeable at the end of last year is you had a very, very out-of-character drawdown on the S&P. Recall, we all know the S&P fell 20%. It's pretty shocking into Christmas. That happened with the ISM up at around about the 56 level. Normally, ISM is already heading to and through 50 before you get a 20% sort of move on the S&P. But we got one, a very, very significant one. Is it valid, therefore, to say that perhaps the S&P was already pricing in the slowdown that we're now having in manufacturing, and that we've already had the drawdown on the S&P? Or should we now be looking for yet another 20% drawdown on the S&P based on the move that we've seen in the ISM manufacturing? And this is going to be where we now come into that whole QE argument, and also the amplification effect, also the passive versus active, the whole change to the framework that's taken place over the last 10 years, which may have nullified some of the old signals and may be one of the reasons why we have to be careful on whether we use this manufacturing ISM data and the manufacturing data in general. The key here is, one, have we already had a drawdown, or should we be prepared for another one of 20%? Or, if we have a resumption of balance sheet expansion, can we hold off a further decline? What happens with QE, and will we get QE? So I'm just going to come back to that chart at the very, very beginning, which was the balance sheets, the combined balance sheets of the major central banks of the world, and the performance of the S&P. And it's really the S&P that's been the really kind of most correlated. Between 2009 and 2015, the S&P basically rallied with the Fed's balance sheet, QE1, QE2, QE3. And then when the Fed stopped expanding its balance sheet, 2015, the S&P went sideways with extra volatility. And then the S&P took off again. And people said, see, it's nothing to do with the Fed's balance sheet. And what it was is that we had an adjustment period where the Fed stopped expanding its balance sheet. The ECB and the Bank of Japan expanded theirs either more in the case of the BOG, or for the first time in the case of the ECB. What they forgot is if you're weakening the euro and the yen, you're strengthening the dollar. That was a rapid move in the dollar, tightened financial conditions, lots of volatility in 2015. Markets went sideways, volatility, you had a mini devaluation from the Chinese. Shanghai Accord came along, dollar stabilized, and now each unit of ECB, so each euro of QE and each yen of QE, didn't impact the dollar. and we went off again. So now balance sheet expansion with the stable dollar saw the S&P reconnect and move higher and higher and higher until we saw effectively the balance sheets peak in 2018. And since 2018, although it made marginally new highs, really we've been going sideways on the S&P with, again, bouts of volatility. But it looks like QE matters. I think there's two more really key charts here which will help frame this whole argument or this whole discussion. They are ones that I've taken from Nordea again, so Andreas, which the first one is what happens to bond yields, growth and inflation when you get QE. Now, most people think you buy bonds and bond yields fall. But actually, what has happened throughout the periods of QE is that during QE, bond yields and inflation have stabilized or gone up. During periods without QE, bond yields have collapsed. Very, very distinct with the Bund, which is the German 10-year. Very distinct pattern where you see a collapse in bond yields. And the reason I think behind this is that the emperor has no clothes. In 2008, the global financial system was well and truly broken, and it has not been fixed. What happens is that the central banks have provided some support through liquidity. It has created a massive amount of debt with no velocity, but it's prevented the emperor having no clothes, where we go, without QE, there is truly no growth. With QE, there is very, very low baseline growth that's unsustainable. It's just a coordinated move across all central banks. No QE, so they basically stopped the bond buying and bond yields collapsed. It's less distinct on the US 10-year, but nonetheless, through periods of no QE, 10-year yields fell. Through periods of QE, 10-year yields generally rose. We've clearly just come off a period of incredible declines in bond yields and flattening of yield curves. And on the S&P, if you look at the S&P year-on-year change, during periods of QE1, QE2, and QE3 from the US, the S&P generally went up and went sideways to down when the US wasn't doing QE. When the ECB came in with QE at the beginning, as I mentioned, because of this dollar dynamic, there was an adjustment period until the dollar stabilized, but then the S&P once again generally did well and outperformed. And since QE ended, the S&P has gone sideways. It hasn't gone down, it's made a few new highs, but it's generally gone sideways. So it would look like QE is key. And then the question is QE coming back? And you've probably seen in the press, there's lots of people talking about QE. There's a lot of semantics around QE. Is this current environment where there has been issues on funding in the US, is the US currently doing QE? It doesn't matter whether it's QE or not. It is balance sheet expansion. And you can see it very, very clearly from the Fed's own balance sheet numbers. There's been 180 billion added over the last 4 weeks to the Fed balance sheet. Is it QE? Is it not QE? I don't care. No one should really care. It's balance sheet expansion. The ECB has said that they are going to re-engage with QE at the beginning of November. And so we know the ECB is coming back with QE. The Fed have been doing some balance sheet expansion. They may or may not do more. They may or may not cut rates. But there's clearly a move towards greater accommodation. And over the last 10 years, when QE has been full-blown force, or has been in force, not even full-blown, generally equity markets have done well. So we've got QE. It looks like it's coming back. So what now matters is the next 3 weeks. And the next 3 weeks, I think, are absolutely crucial to this whole debate. We're currently in the buyback blackout period in the US. So as the corporate earnings kick in, they start really properly next week with the US banks. We're in this period where there are no buybacks, so there's no support. We've just come from a period, and I'll show a chart later, where we've had record quarterly buybacks. So we're in a period without quarterly buybacks at the moment, or without buybacks. The ECB has not started QE yet. The US has expanded its balance sheet, but it has not started official QE yet. The Fed meets on the 30th of October, and they haven't cut rates yet. So we're in this very vulnerable position. And in fact, cutting rates so far has only high-ticked the S&P. Twice we've seen the US cut rates over the last couple of months. The first one was about 30.25, and the market rolled over. And then they cut again a couple of weeks ago, a few weeks ago, and the market kind of peaked at 30.25. Cutting rates on its own doesn't seem to be necessarily sufficient. And these markets keep on looking a little bit vulnerable. And there was some interesting stuff that Northman trader Sven Henrik, who I was interviewing yesterday, is coming on to Real Vision in about a week's time. And he said, look, we've got to that point where the S&P market cap to GDP is in that sort of 140, 150 range. And in 2000, in 2007, in 2015, in 2018, you got to roughly 140 to 146 market cap to GDP, and the market struggled. It's almost like that's a barrier to further upside. So we've got this period of risk. Now, at the same time, the other thing that could see us move the other way is there's the trade discussion that's going on. There's always seems to be a partial resolution, but we still seem to be a very long way from a full resolution. So this is, as we've seen, and when I was looking at the markets just a few minutes ago, we've had another good day today on the back of a potential partial resolution. But we're still in this window of risk. And I think there's a couple of things we can look at for that risk. Because obviously, can we break that 30.25 level on the upside? Okay, that's great. That will see we're onto a new move higher. On the downside, I would say look at 2,800 on the S&P. That converges the 100-week and the 50-week moving average, converging on 2,800. If we hold above 2,800, this is a relatively stable market. And if we can hold above there into the end of this month, where we get the Fed, where we get the ECB starting their new QE, and we're coming back into the buyback period, then that probably sets us up quite nicely into year end. However, if we break 2,800, I think there's an acceleration point to the downside, and we'd have to then think about the next big level below there, which is the 200-week moving average, which is around about 2,500. That has defined pretty much the trend over the last 8 or 9 years. So this is this window, 3-week window, in which we need to be careful. And there's one other element which I think is also telling us, giving us a warning sign, which is volatility, so the VIX. The VIX is at 17. Not massively high, but it's nowhere near the lows of 10. The VIX normally rises into a significant market peak. You almost never get a market top with the VIX at the lows of, let's say, 10. The VIX has been moving higher to 17, with the S&P trading around the all-time highs. The reason why this matters is that if you do get a rollover, and ahead of that market peak, volatility was towards the upper end of the, let's say, the average range, then a lot of people say it's too expensive to hedge, so fewer people hedge the market. So volatility rising is nearly always a prerequisite for a market peak. And today we have volatility, the VIX rising. We also have realized volatility, so this is actually what the market is moving on a day-to-day basis, has been rising. And a higher realized volatility is a trigger point for a lot of rules-based funds to sell the market. So those risks are all coming to the fore here and now with the equity market in this window of risk. So in conclusion, and there's many other things I would love to talk about, but would take far too long, which is the overall market structure, the switch from active to passive and rules-based funds who are now dominating the flows along with algorithms. What are the drivers of this? Well, it's been this convergence of returns, which is actually a function of global central banks compressing yields, compressing returns, compressing GDP, compressing cross-asset volatility. That's the framework. But it's a framework that is not yet broken. And for me, this is the key, is that if we get through this 3-week period, I think that central bank liquidity is still going to trump the signals coming from the manufacturing sector. Global liquidity has been what markets have thrived on. Global liquidity and very low growth, so 1% growth with liquidity supporting it, is when the S&P has outperformed. And based on the last 10 years, we get more QE from the US, and they need to because of the funding issues that have been talked about a lot over the last month and a half. But the Fed need to do QE. If they come with QE, If the ECB starts QE, which they will again in November, and we haven't broken down in this key 3-week period, then a grinding market to the upside with a potential into year end becomes a much, much more significant risk. Now, how are people playing this? Two things that people are doing. One is if you're long in, if a lot of people are long equities have started taking down their equities, going into cash, buying a call, so we break to the upside, you will participate even though you will underperform. But if we collapse down, you're in cash and you can buy the market. So that's one thing. Another thing people have been doing is just buying protection, so buying put protection around that 2,800 level. But I would say that it feels we're in an environment where we're not quite ready to roll over yet. My caveat to this is, remember 2000 to 2003, remember 2007 to 2009, we saw interest rates cut, and yet the market fell and fell and fell. Cutting interest rates is not going to save this market. It will need QE. So I don't really care whether the Fed cuts once or twice. That's of almost no relevance. They need to pump liquidity back into the marketplace. But then the other thing which is key is it's very, very rare for a market to go into crisis mode when financial conditions are very, very loose, which they are today. So one of my last charts shows the probability of a recession 12 months forward is very, very high. It's based on the yield curve, and the yield curve itself may be distorted by central bank actions themselves. The financial conditions are very, very low. They're at levels from which we have never seen a recession over the last 30 years, but they can move very, very quickly. And if the dollar breaks to the upside, that will tighten financial conditions significantly as well. But at this stage, it's not yet happened. It still feels like we're a little bit, maybe 12 months, maybe 6 months away from a full-blown recession across the whole framework. And central banks still have the firepower to provide sufficient liquidity to support the markets beyond most expectations. And what may even be the most surprising element of this, and I'm actually a confirmed, unreconstructed perma bear, is that if we get weak data, but we get preemptive action, we could have a recession. We could have a recession in which asset prices remain remarkably buoyant, and therefore the transmission effect into the consumer and the individual is far less powerful and far more muted than we are used to seeing. So in conclusion, there's a lot of risk here. Central banks have said that they want to be more preemptive, and they have to be, because the bubble of absolutely everything is a very, very unsturdy pile of assets which are waiting to fall. And central banks know that they have to keep the charade going, otherwise it properly lights out. And I think that if we get through this next 3 or 4 week period, I think that central banks are going to come back with liquidity. And I think that the central bank balance sheet story will trump the ISM survey story in the short run, and therefore is still a smaller risk to the upside, with the final point being, if the trade war blows up, all bets are off. If the trade war is miraculously solved now, we'll get a positive reaction to the upside. I think the trade war will continue to just rumble on for months and months beyond where we are today. So I hope that was a sort of useful view on the framework, the key issues, and these two conflicting stories between QE and balance sheet versus very, very clear deceleration in manufacturing. There's no clear answers. I've fallen on the side of being maybe slightly more positive than I normally would be, but I think that that new framework is the one that we have to believe in. So with that, I would love to start taking maybe any questions that come up, and I'll see what I can do with those. Thank you. So I think key question here is QE. Is QE going to be enough? And I think one of the key elements here is that it is very, very clear with this manufacturing slowdown that QE and interest rates accommodation is reaching the very limits of what it can do. So unfortunately, if you believe in true capitalism and free markets, we're unfortunately into something, I wouldn't call it unpleasant, but yes, the fiscal side has to come in here. It's why Lagarde is in at the ECB. It's what the UK will do if we go into a clean, hard Brexit. And it's what probably the US will do, but maybe now after the next elections. That's a one-year gap. But it's very, very clear that we are now absolutely at the edge of what you can do. And I don't know if anyone saw, there was a big move to the upside in JGB, this is Japanese 10-year yields, about 2 weeks ago. They can't really do much anymore. Everyone's rocking a hard place. Is that QE overall, the framework has either the framework has driven yields down, the low growth has driven yields down. Flat yield curve kills your banks. So if you don't want to kill your banks, you need to steepen the yield curve. Well, in Europe, that will kill your banks. In Italy, so it's a rock and a hard place. It needs fiscal. Unfortunately, it needs fiscal. It needs MMT, or it's going to get MMT. I'm not saying it needs it. I think it should have cleansed the system. But unfortunately, QE on its own won't work anymore. Interest rates on its own definitely won't work anymore. QE, interest rates, and fiscal may keep the charade going one last time, and then we have the mother of all blow-ups. And markets are totally rigged by central banks. So how can I predict anything? It's true. It's very, very hard. Do we get socialism on the back of this? I think, unfortunately, we are going to get a form of socialism in anticipation of this. This is why gold is such a good trade, because gold, people often think, is something that you hold for the blow up, but actually gold, particularly recently, is something which has done superbly well in anticipation of central banks becoming preemptive on a much more nanny state type of mentality. The one thing that might ride to the rescue of those who don't like the concept of MMT is if Japan, which has done MMT, it's done all the fiscal side, it is hurtling towards its final destination, because I don't know if anyone saw, there's a Shannon McConaughey was on our channel, who's done a lot on Japanese banks. But Japanese banks are now, their income from new loans is below their costs. So they're now hemorrhaging cash. They're close to the end game. And if Japan reaches the end game, despite MMT, despite all the shenanigans that the central banks have done, then maybe other central banks and other policymakers will go, hang on a minute, this doesn't work. But as it currently stands, almost every policymaker and almost every central bank is looking to join government spending with buying of bonds from the government in unlimited amounts. That clearly creates a massive distortion. It's rigged. And then when do we get to the Minsky moment? And that's the key. The Minsky moment is the unknown point. Is it next year? Is it this year? Is it in 5 years' time? And yes, gold will free fall, and I think the brisk gold will free fall into the initial implosion, because if I've got my money in gold, I've got some money in gold, I've made some money, but if I lose on the other side of the coin, I might take some cash out of gold. But that doesn't change the long-term thesis for it. So gold did sell off in 2008, but then the recovery mode, gold did well. But right here, gold is in a great position because it's an inflation hedge, it's a deflation hedge, it's a fiat currency hedge. And in negative interest yield world where 14 to 17 trillion of negative yielding interest rates and bank accounts at minus 75 basis points in Switzerland, it's cheaper to hold gold. Emerging markets will continue to be dependent upon a combination of the dollar, the absolute key element. If you do the chart of the ratio of the S&P versus MSCI emerging markets versus the dollar index inverted, it's the same thing going back 30 years. The dollar goes up, emerging markets will underperform. I think emerging markets will have their day as the phoenix that rise out of the ashes, i.e., you only get a new investment regime at the end of the old investment regime. We're currently in an investment regime based on passive central bank liquidity, US outperformance, and I think that's where we go before emerging markets. But having said that, also, it's very clear within the emerging market space, unlike in the 90s, emerging markets had a very high internal correlation. Today, emerging markets have much more dispersion. So you do your work and you pick your country based on current account, surplus deficits, demographics. There are some hotspots, but nowhere will be particularly immune to a massive move in the dollar to the upside, a disorderly move. If the dollar grinds higher, everything should be okay-ish. But if we get a disorderly move up in the dollar, that's bad for emerging markets and risk assets in general. So someone talking about credit spreads here, and I think this is absolutely key, and it's why financial conditions are still low. Credit spreads and credit in general is stable, even though there is this massive risk in triple B, etc. It's a bit like Japan. Japan has been in deflation, GDP declining, but because interest rates have been falling and falling and falling, it has allowed zombie companies to go on and go on. Now, the Japanese framework, I think, is a slightly incorrect one for the analysis. This is my analysis, obviously. Japan was lucky in that its demographic time bomb blew up when the rest of the world was still growing, when China came on board and all the rest of it. So it was supported, its negative demographics and declining credit world was supported by a global expansionary environment. Today, the West has not got the support of an international system. It's not got the support anymore of China, because China's now retrenching as well. It's hard to see how things blow up whilst credit remains relatively benign. And the one I actually watch first and foremost is US high yield and US high yield energy. They have attempted to break out, but have held back. The key here is that in 2008, when we had the credit blow up, you had credit spreads blew out, but interest rates fell, they plummeted. So the absolute credit levels were relatively static. Credit spreads blew, but also you had interest rates falling. So one slightly offset the other. Today, with interest rates at 2% in the US, you have less of a cushion from interest rates. So if you do get a credit spread blowout, it will create problems. But at the moment, if you think the Fed is going to cut rates, put in more liquidity, and potentially buy credit, then this is why my view is I would support the central bank balance sheet supporting risk assets over the ISM telling me to sell risk assets in an environment where central banks, in my view, don't have an equity put. They now have a fixed income put. They don't want to see yields go way over 3% anymore in the US 10-year. They don't want to see credit spreads blow out. In Europe, they're buying credit, which suggests that this low growth, grinding, P expansion environment can continue, even though the real economy is clearly struggling. Something on the banks hiding their losses, yes. If you can get hold of Shannon McConaughey, if you are on Real Vision, Shannon McConaughey went through all of this, and basically dodgy accounting is the nice way of saying it. Economical with the truth would be a nice way of saying it. Fraud would probably be more accurate. But there have basically been legacy non-performing loans have been turned into, for instance, loans have been turned into equities, which equity gains have been then turned back into interest income rather than capital gains. All sorts of things which now regulation is changing. The key thing for the Japanese banks is that they are interest on new loans, I mentioned earlier, is now below the cost of running the banks. So this is the end game, so they can't hide them anymore. We've been waiting 30 years for Japan to end. I wouldn't say Japan's going to end in the next 30 weeks, but certainly I wouldn't want to be short JGBs either, but there is a lot more risk to that one now. So where are the biggest bubbles? And so Austin, firstly on Austin, yes, they're constantly changing. they're constantly using new tricks to change where they hide the loans. But there's a couple of other pieces which came in, which means that the people who owned the bad real estate can now get out, not quite scot-free, but relatively free. Where are the biggest bubbles? I think the biggest bubble would have to be in the fact we've got negative yielding debt, but I think it's also in this whole corporate side of things. So corporate triple B is a bubble waiting for a windshield, but that windshield is a bubble, it's a bug waiting for a windshield, but that windshield might be a long time in coming if central banks continue to provide this support. So this is why, and I think this is a key element to the markets at the moment, is that there are nuclear weapons out there, or there's this nuclear catastrophe waiting to happen in markets. But it's a bit like, we know that there's lots of nuclear weapons in Russia, America, and China. And we know that if they all go off, we're all doomed. But we know no one's going to press the button. We know there's problems in derivatives. We know there's problems in the size of the triple B market. We know there's problems in China and its excesses. No central bank is going to intentionally press the button. The difference between, I know it's a bad analogy, but the difference between war versus finance is that there are so many different elements playing on the financial system that it's very easy for something unexpected to happen. One of those things could simply be that if Japan does start to deteriorate further and the Japanese bring home all their overseas investments, and they've been one of the biggest world creditors over the last 10 years. They've been like the Bundesbanks buying the mortgages of the last decade. The Japanese have been buying pretty much everything. If there are losses back home and the Japanese bring home their money, then that could withdraw liquidity unexpectedly, and suddenly all these bubbles start to implode. But I think it's going to have to be something from the left field that does that, because every central bank is absolutely bricking themselves about this whole house of cards built on sand. So if I mix all my analogies or whatever, everything there, they know this. They have to keep the charade going. But in financial markets, there is always something that somebody can't predict, like they didn't predict that Lehman would be as bad as it would be. Retrospectively, it sounds incredible, but that's so there's a lot of risk out there, but knowing that there are nuclear weapons is not the same as knowing that someone's going to press the button. And I think that in some ways is key to think about how central banks are approaching it. Deutsche Bank is a problem. I was there, but I think the way to look at Europe is that if you look at the chart of the SX70, it's in the pack. A lot of European banks are going to be nationalized. There's going to be a wave of nationalization across Europe. I mean, I sort of always argue when I was at Deutsche Bank, we just did the numbers, 600 billion balance sheet, if I'm being charitable. In a common or garden recession, you get 10% non-performing loans. Let's be charitable, call it 5%. 5% of 600 billion is 30 billion. Well, that's more than the total equity of Deutsche Bank. So that's wiped out. Government has to come and step in. Commerzbank the same, and most of Italy, half of Spain, UK, maybe not. So yes, I mean, there's stuff, but I think that the banking sector in Europe is a problem child, but it becomes less of a problem child when Germany is forced to nationalize its banks, at which point Italy can go, okay, we'll extend again, we'll extend and pretend. So that, I think, is one of the things that might come through there. So what happens with central banks if inflation comes in, but we basically stagflation? It's probably the question that I think has the most people worried, particularly the traditional economists who have always expected the liquidity that we've got in the system to turn into inflation. And I think this is in some ways why the Fed was always keen for the last 5 years to try and raise interest rates, because if you think about the money that they put in, 4 trillion, the Fed themselves, 19, 20 trillion from all the central banks, with this very, very, very low velocity of money. So it just sits there sloshing around, doing nothing. It's not creating capex. It's not going towards capex. It's effectively going into assets. Goes into assets, assets go up, no velocity of money. If you ever got any sign that there was even an inkling of an uptick in the true economy, then that money sloshing around with a low velocity suddenly has a very high velocity and suddenly kicks in and potentially becomes inflationary. Now, the reason why I don't think we will get to true stagflation is that I think we are an inflationary bust, one inflationary bust away from true deflation. And what I mean by that is just think about the 3.2% we got on the US 10-year. We got up there and then boom, it failed again. It rolled over. It was an artificial rally in yields based on an artificial and coordinated central bank liquidity that created some form of growth. But actually, the more money that goes in, the less velocity it has. And there's a chart I can show you. I'm not sure how this turns out on screen, but if money going in is there, velocity is there, and actually look at central bank balance sheets in 2018, they peaked and started to go down, and velocity of money, this is M1 US, actually started to turn up. But then what happened is that 3.2% US 10-year, we reached the tipping point for yields on an economy and a global framework that's been built on debt, and it came back down again. So I think that inflation, if everybody is cutting, if everyone devalues by 10%, then no one devalues. If the dollar goes down 10% and euro goes down 10%, well, they haven't moved. And most of the inflation is outside of 1970s, which was a bottleneck inflation, more people coming onto the planet than people expected, plus very poor governance and a framework which was inflationary. But otherwise, all the big periods of inflation have always been a single country misunderstanding or abusing its exchange rate to create effectively currency inflation. Today, everybody's trying to devalue, therefore nobody's devaluing, which is why we've had such a low volatility of FX. And no one's quite broken that. Someone will, maybe Japan will be the first one, but first the yen will probably strengthen before it falls. So I think there is a risk of that, but it still feels that we've got a deflationary framework, and it's still a vast pit of money, and they keep chucking credit into it, but it has no velocity. And until we start to see velocity pick up with money going in, rather than velocity falling with money going in, I still think we are unlikely to get that stagnation, stagflation type environment. But clearly it's a risk if we get any real tightness in particularly the US. So I just wondering if there's any more questions. I'm sorry, I know there's a lot of questions that were asked there and I missed some of them. They were going by and I've got my lenses in and my eyesight in my old age now is starting to fail me. So hopefully I've picked up most of them and covered most of the things, but I'll give it a couple more minutes. If there's any obvious big questions that come through, I'll try and answer them. So there's two questions there, which I'll try and do at the same time. One is Russell 2000 versus S&P and short-end US yields. Why are they this similar? So I think the reason why they're sort of similar is that, firstly, the S&P and the breadth of the market is very clearly been focused on a narrow range of stocks in the S&P and the NASDAQ. So we've had the Russell rolling over, the transports rolling over, we've had the banks rolling over. So sectors, the equity market internals are trading as if there is a recession on already. So everything apart from the absolute level of the S&P is trading like a recession. But the absolute level of the S&P is trading like there is growth out there. And yields are trading like there's a recession. But in a world where money's coming in from central banks, it's just being flicked on, comes in, everything goes up. So bonds go up, equities go up. And because of this world of ETFs, money finds its way to largest cap stocks via the ETF market, by the passive market, which is indiscriminate, and that's what's really happening there. So I think the Russell is an indication that Russell is a little bit more real economy. Russell doesn't have as much money coming into it passively, but I also think it's an indication that the narrowness of the US market. The front end rates in the US, a lot of people talk about the idea that euro dollars will go a lot higher. So euro dollars are they're not the same as Fed funds. Euro dollars are the international markets, the funding of dollars internationally, mainly how banks fund themselves, etc. The euro dollar market will rally aggressively if we go into a recession, but it comes back to if we think QE is coming, and look, remember those charts I showed earlier. If QE is coming, then we should have a re-steepening of yield curves. We should have both long end and short end yields find support. Doesn't mean they go significantly higher, but they should go higher. But the trade I always say is, if you're unsure, you buy 100 strike call on the euro dollar, probably DEC 2021. 100 is basically zero interest rates. Zero interest rates means something very, very bad is happening in the US. So it comes in and out because it's sometimes a good trade, sometimes it isn't, in terms of maybe how professionals would look at it. But you buy it, it's not a massive cost. And if we get a real crisis that just suddenly hits home, we're going to see US interest rates go towards zero, which means that if your current euro dollar futures, let's say 98 and a half, which implies 1.5 to 2% interest rates, it'll go to zero, which means it goes up through 100. Effectively, that's where we are in Europe. If you've got bond yields at minus 75 basis points, you're above 100 effectively on the equivalent future. If you're on Euribor, will be the one to really look at there when we've got negative interest rates in Europe. So I think based on my scenario, we should have sideways to slightly higher front end yields or interest rates. But longer term, I believe in convergence to zero and flattening of curves. I think the 10-year will go to zero. I think the front end will go to zero. And there's a potential for more inversion in the US, because I think that the front end will be locked with Fed funds, which I don't think will go below zero. But I think the long end, like we've seen in Germany and other countries, can, because it's freely floating. So hopefully that was reasonably useful. Hopefully I covered a few of the questions, and apologies to anybody whose question came up and I didn't get time to focus on it as they're going through. But there's, as I said, there's a lot of stuff in the pack, and there's quite a lot of the stuff has been covered on the Real Vision channel, on YouTube channel, over the last few weeks. So hopefully that was relatively useful. Thanks very much for your time. And I'm going to end there and go off for my dinner here in the UK and catch up with my kids. Thanks very much, everybody. Thank you for listening in. Cheers.